Good. Okay.
Okay, last but not least, we're going to put this mic on George. Floor is all yours. Tell us how to save our treasury.
That's not my job.
Go there, George.
Good evening, everyone.
Your name?
Good evening, everyone. My name is George. I'm a hacker resident here at Founders House. I'm a member of the Founders House. I'm a token holder. I am deeply invested in this business, in this community. That's, I pretty much like to be here. The first time I met those guys and what they are doing here, I just to join the band, I'm from here, from Floripa. I've been living here since I was born. So if someone would like to keep track of the presentation in Portuguese, I have one presentation in Portuguese too. So today is the first token night. Different. Yeah. Some people ask me, so it's AI token? No, man. This is the new word for token, but we're going to talk about tokens in blockchain, So for this first token nights, we came here, demystify some concepts about DeFi and bring some opportunities in DeFi and bring some of the concepts of DeFi. We're not going to make a hands-on night today. We're talking about strategies and some pitfalls you can find in DeFi, Going on?
You have to give us access later.
Oh my, it's public. I'm sorry. I could not do that now.
It's okay. You can do it later.
I'm so sorry. But I think I put it public, but whatever. Sorry. So here's some of our objectives for tonight. Talk about why DeFi matters and why founders must understand at least understand the concept and understand the opportunities in DeFi, The core primitives, the liquidity pools is one of those. Structured lending, and at the end we'll have a little playbook for founders how to navigate this ecosystem. So we need to understand the operation model behind on-chain yield. That's the core principle. Distinguish productivity yield for incentive-driven noise. Design a conservative experiment without endangering your operating cash. So our agenda is pretty much blown up. So foundations, we're going to talk a little bit of blockchain concepts, EVM, custody, DeFi rails, wallets, dApps, bridges, dashboards, liquidity pools, mechanics, yield risks, structured lending, collateral leverages, cash, implementation, and question and answer. But foundations, money, DeFi came from decentralized finance, right? So it's finance without a central organ. But we'll see a little bit further, that's not a really DeFi thing. Today, we call it DeFi, but that is a shady thing to say. So blockchain is one business sentence. A standard ledger for for a business is a standard shared ledger settlement, ownership, and auditability are native to the network. So it's a principal concept for a founder to understand about blockchain. It's pretty much a ledger everyone can see, and there's some blockchains but this is another problem. So we have a transactions who makes a block when they are mined, a consensus to say what kind of transactions we accept, the finality, and one audit trail. What is the selfless? audit trail. Bitcoin, Ethereum, and EVM chains. Pretty much my fellows, people who know me, tell me that I am a maximalist Bitcoiner. So the truth is, I am not. I cannot tell that I am a maximalist of Bitcoin, but I still hold pretty much only Bitcoin. So let's talk about this through this night, okay? Okay, but I'm not in front of the. So Bitcoin is pretty much designed for cash digital money. If I go through there, better or no?
Yes.
Better? Okay. Okay, Bitcoin is pretty much monetary based, designed as scarce digital money, conservative security model. This is not designed to be a computer like Ethereum, you know? It's a storage of value for me today. I started understanding Bitcoin, started learning Bitcoin in 2016. I just pretty much understand this years later. So then came Ethereum with EVM. Ethereum is a programmable finance, so we can build smart contracts, run financial logic, tokens, lending markets, DEX, and composable. Many other tools reduce costs and improve thoughts. In Bitcoin, we pretty much have one functional L2, which is Lightning Network, and it serves just for payment and do its job really, really well, much better than any water EVM. I know because I expect the people pay and Bitcoin, I should use a Lightning Network. I'm not going to on-chain, wait for 10 minutes for the transactions be confirmed. So for the other way, you can have tokens, we can have different kind of assets. You know, when you do a payment in your transactions, your fees are paid in Bitcoin. In Ethereum, you will be paying in Ethereum. But Ethereum was made for this purpose, as for the fee, not storage of value. That's my point of view. This is my take on Ethereum. But it holds tokens. We can build things on top of Ethereum we could not do in Bitcoin. Self-custody, change the control model. So before talking about DeFi, so for the presentations, I saw many of you understand blockchain, understand the concepts. But one of the things DeFi needs is self-custody. You need to have deep understanding of what is your private key, what is your one wallet, how do you manage this? Later on, we'll talk about hardware wallet. I don't see at least me using DeFi without a hardware wallet. So that's a good concept. A signature in blockchain, a wallet can be your signature to approve a transfer, your login for some dApps, or pretty much everything is based on your address who came from a wallet, you know? So a discipline matters in this aspect of DeFi. You must understand how to use your wallet before doing anything we're going to talk forward. So hardware wallet, backup, allow list, transactions review. We're not going deep in any of this aspect, but these things I put in green is just pay attention for this because this is quite important, you know. So L1s and L2 and bridges. Ethereum, let's talk about, for now on, I'm going to talk only EVM, Ethereum Virtual Machine blockchains, right? There's other blockchains like Solana, Polkadot, Cardano, but let's be honest, let's go for EVM. That's the really blockchain. designed for the DeFi, L2 came to improve scalability, reduces costs. So every time we use Polygon, for instance, we do a transactions in Polygon, we'll pay gas in Pol. And from time to time, that blockchain will settle, will make that transaction permanent in Ethereum blockchain. This is what L2 does. L2 abstracts the security layer, gains scalability, and make you pay less for your transactions. And with heritage, taking the security layer of the L1 blockchain. So rollups L2, dApps. dApps are everything we're going to talk about. This is an app. No, it's decentralized app. We're going to talk about Uniswap and a few others. So this is an app. What is a bridge? Bridge came here to make transfer tokens from one blockchain to another. Actually, they don't transfer blockchain. They take your token from one blockchain and give you other tokens in another blockchain. Most of the bridges do this. I don't recall any other who mint tokens or real transfer tokens from one blockchain for another. If USDT was born in Ethereum, it will be on Ethereum. And probably there's USDT in Polygon. It's another USDT, but if you bridge, you're going to swap one for another. I don't know if I could make myself clear, but it's just conceptual. Bridges make you swap from one bridge to another, one blockchain with another. Decentralized is not binary. Remember that I told you DeFi is not completely decentralized. There's a few more about decentralized, though every protocol has centralization vector, code, governance, oracle, custody, validators. In some point, is centralized. There are people who say that Bitcoin is centralized because there's a few, there's not too many core developers. It is a centralization point. In Bitcoin, this is a centralization point, So there is no such a thing as 100% decentralized, but it's, so you can understand this is a risk. So be conservative. You can use blue chip protocols, battle-tested contracts. You can be moderated. New market or no infrastructure is used. This app is running for quite some time. There's no problem. I'm gonna use it to test. Okay, high risk, opaque incentives, new contracts, team liquidity. Every day, every hour, there is a new token on the market. Every day, every hour, there is a new app on the market. I'm not saying they are not good or they are evil or they are high risks, but let the market mature this, guys. Don't go for it, And this opaque incentives means that sometimes there's a liquidity pool with some shady token, give you incentives to put your money here. I'm going to grant you a yield for 20% amount. Be aware that's probably a scam. They will give you that token. You think you're gonna make money, but sometimes this money just disappear in a blink of an eye, So critical risks, anonymous team, unaudited code, high APY. I'm talking about high APY. Be aware that probably is not for what we expect to use here. Let's see, DeFi as a financial infrastructure. So I'm going to talk about a little bit of money Legos. What is money Legos? We're going to use our infrastructure, right? I have a debt who gives me the ability to take a loan. I will have a debt who I can use to make a liquidity pool. I can have a debt so I can have something other kind of incentive to make money. Money Lego is to use that to structure like a Lego. You can use this to structure your strategies. So we're going to use this tonight. We're going to talk about a little bit of this. So you have a wallet. It's your interface where your funds are. A DEX, it's a decentralized exchange, like Uniswap, for instance. If I want to swap USDT for USDC, I want to buy WBTC. It's a pegged token on value of Bitcoin. I can use a DEX for these swaps. I can use lending. There's protocols for lending. I can put my Bitcoin, my WBTC, my token, peg it to Bitcoin value or my USDT, USDC, whatever, and put this as a collateral and take a loan on the value of my asset. This is pretty much what rich people do. They have assets, they don't have money, and take a loan to live. You know, this is available for plebs like me, like everyone in DeFi. LP token, liquidity pool token, we can provide liquidity. We can be an automated market maker, so earn yield or fees for people using our money or assets. And we have to use risk dashboards. So we have some dApps that are dashboards. We can put our wallet now there and say, look at, this is my wallet. Look, this is my transactions. What kind of risks I am exposed. So this is we can multiply capital efficiency. We can also stack dependencies and hide correlations. And a founder should model every Lego as a vendor contractor or risk factor. As founder, that we are talking about using this for use your money, your assets, not only your personal, but from your company. So you can understand this is, you need to take it seriously, not just go sit down and press some buttons and do whatever you think you are doing, because this is high risk.
George, a question. Should that be tangible and intangible assets? So can you borrow against intangibles?
Intangibles, you mean?
Okay, an IP value, for example.
Sorry?
Tokenize the value of your IP and borrow against it.
If there is a protocol who is willing to take it as a collateral, yes, you can. If it is a token in a blockchain, you must find a DApp who accepts this. DApps are now closing the circle, you know. There's in recently times, there's some liquidity issues with some DApps. They lose some money. So yeah.
I think you need another lecture on like tokenization, but
Yeah.
explain that like the whole like
Yeah.
so many issues with this.
You see, every time I tell him here is just the surface of the thing. Each slide of this could be 10-hour talk about this. So it's
So what we're talking about there is asset-backed tokens that you can borrow against.
yeah. Let's see here. So a simple map for wallets. we use Rabbit or hardware wallets. I use the combination of those two. This is a browser extension. I connect my hardware wallet to this, and all my assets, only transactions need to be signed by my hardware wallet. I must be doing this in person and physically. So DEXs. So talking about dApps, or is a category of dApps, decentralized exchange, where I can swap coin to another, one token for another, right? There are some examples, Uniswap, but there's PancakeSwap, Aerodrome, and a few others. Lending, I like, but there is more focus, and there's protocols that for lending in a lot of blockchains. There's on Solana, there is a huge dApps there too, but use this. So aggregators, 1inch. What aggregators do? You mean I would like to swap for my USDT for some WBTC, right? I go to a 1inch, one aggregator, and it will make quotations in every decentralized exchange and give me the best route and best quotation for that transaction. So sometimes I use 1inch. There is others, but mostly I use 1inch. Dashboard, I like to use Revert. So when I would like to see how my positions are, I go to Revert, and they give me a pretty much every calculation I had to make. Revert those for me. So if I want to increase the liquidity or decrease the liquidity, Revert has tools to make it pretty much easier. So that's my goal when I would like to make my change my positions. It's Revert. Risk to revoke cash. There's a lot of risks, and no one's think about this. Every time you make a transaction, you sign. Every time you interact with a smart contract, you give permissions for that contract in your assets, in your wallet. So those guys there, scanners, audits, and mostly revoke.cash, could make you see this more clearly and wipe out those permissions. You revoke all those permissions. No one can touch my money again. So this is some tools. Stablecoin. The cash leg of most strategy. No one knows what the stablecoins are. Someone doesn't understand stablecoins.
No, someone who doesn't. Maybe
Yeah.
explain it. Yeah.
Yeah, stablecoins, it's just tokens pegged to a value of fiat currency, you know? So you have USDT, USDC, and many others. These two are the most, the biggest ones. So pretty much dollar. We have Brazilian reais. There's the PIX. There's a few others. Who cares? There's euro. You can have stablecoin of euro and pretty much every currency today. So why those stablecoins matters, especially if you are a founder. If you're going to use your treasury for your company, you eventually no, pretty much certainly you have to make the accountability, make the accountant understand these transactions. And if you work with stablecoins, you will be talking to those guys more easily, you know? So make the base, and pretty much everything we talk today is about dollar. So stablecoins pretty much to verify. What to verify about the stablecoin? Who is the issuer? What is the reserve model? For instance, USDT, for each dollar they emit, they buy $1 in government treasures, funds. I forgot the name of the bonds. You know, those guys do this. Bills. Yeah. So they do this. This is the reserve model of this. But they have other coins and everything. There's a case of the USD, TUSD, the Luna thing. They tried to make an algorithmic stable coin, baked by algorithms. And from a few hours, they just collapsed. So if you have $10, $1,000, $1 million of that coin in a matter of hours, you pretty much have nothing.
George, can I ask a really silly question, just for the benefit of people?
Mhm.
How do you make money off stablecoin?
How do you make money? Take USDT, for instance. When they buy bonds, the name, they have some yield on that bond, right? You gave them the dollar to buy that. You gave them, they give you a token, 1 for 1, right? They keep the yield for them.
They keep the yield.
Yeah.
So again, that's the question about it.
Who holds the bill?
Yeah, who owns the real value? So if I buy
They
a
have.
token for $1,
They have the real value. You give it to them.
they're making the yield on the treasury bond.
Yeah.
So why do I want to buy a stablecoin?
Why?
Yeah.
Because stablecoin allow you to do this kind of stuff you're talking about here.
Yes.
You know, I can pay today. We can pay a beer.
Yes.
You can use to pay your credit card bill.
For example, a friend of mine was investing in my son. We use a bank in Canada, and he misplaced one number in the bank account.
Yeah.
The wire was lost, and then he returned for him in 30 days.
Yeah.
So it took 30 days for the bank to give it back.
Yeah.
Then he paid like 5 or 10% fee.
Wow.
To go and come back.
Yeah.
And everything else.
Yeah, that's the question for people who don't know what.
Yeah.
No.
Why would you want to?
And if you imagine DeFi without stablecoins,
Right.
everybody was exchanging Bitcoin for Ethereum, for Solana, for Polygon, and nobody will understand really how much value I have this
So
in
they're
this guy.
extremely valuable
Yeah.
If you know how, if you know what they are.
Yeah.
Yeah, that's the whole point. And the fact that they're asset backed
Hmm.
is an additional layer of security.
Yeah, yeah.
All ours are pure crypto, such as Bitcoin.
No, they must be backed because this is what to verify. The issuer, the reserve model. I'm gonna use this kind. I'm gonna make a treasury with this USDT, USDC, whatever. I would like to understand the guys behind this, how they do this, how they emit this token. You know. So
USDT is like one of the top 5 companies.
Yeah.
Because of profits per employee.
yeah. But in the other way, we need to see the chain bridges and chains and bridges exposure. If you want to use a token, a stable coin, who only works in one blockchain, for instance, let's say, probably I'm wrong right now, but let's say the Binance has a stable coin, is BUSD or something like this. They only allow this or emit this token on the blockchain. If I want to go to Ethereum, or if I want to go to whatever, I don't have. It's the same case of fiat. I just limited to that way or that blockchain. So
So it's better to have multiple chains.
yeah, it's what to watch on a stablecoin. How many blockchains they emit tokens? USDT for now is the biggest one. They started with Tron, Ethereum, pretty much everywhere you can use USDT. So you can bridge from one blockchain to another and keep the value of your dollar, right? Liquidity depth and redemption path, or whatever is. If you say so, if there is a problem, I can redeem my dollar. You know, where is the liquidity of this token? If yeah, no, and if there's liquidity everywhere, there's multiple blockchains accepting. Probably you have a good liquidity to exit if you want to. So scanners and dashboards we talked about a little bit earlier. So we have transactions hash. You can go to a block explorer to see on blockchain where are your transactions. You have a portfolio dashboard. I talk about Havert. Havert is just pretty much a blockfolio dashboard. I put my wallet there, and so where is my liquidity pools? Where are my loans? Where is everything? Allowance review. You need to make accountability of your, so you have to have allowance review and monthly report. So pretty much this is why you use scanners to verify your transactions and contract interactions, portfolios to aggregate wallets across chains, and allowance review to close unused approval. So remember that guy I talked about, the revoking the permissions. So let's go for the interesting part. Liquidity pools turn liquidity in fee and revenue. Do you guys remember when I talked about I go to Uniswap to swap my money, my token for one coin to another and everything? So who provides that liquidity? Is the debt itself? No. That liquidity came from liquidity pools. So for a few times now, for a long time now, we can provide that liquidity. So you can be market makers, when in a financial systems, traditional financial systems, there's market makers, but it's not allowed to people to participate on this automated market maker. So with liquidity pool, we can do this. You can deposit assets in a pool, use that by traders to swap. Traders pay fees to make the swap, and liquidity providers receive a share. The pool replace order books. Everybody knows trading, right? You can go to an exchange, set a price in order book, and expect that to go there, or you just sell for at market price and whatever. With liquidity pools, we can have set up kind of range to buy and sell your assets. Where yield comes from, real trading fees. So everybody trading in your pool pays you a fee. You can have recurrent volume if there is a volatility in the market. We receive more fees. If there is a volatile market, you receive more because of the liquidity is changing. The price is going up or down. And lower volatility pairs will be more stable, but will take longer. So I'll see a graphic to understand. So the automated AMM is automated market maker. There's a few trade-offs, right? What the pool gives you, automated market maker, as I said, you can provide liquidity and earn these fees. Before DeFi, most of us cannot be a market maker. It's really hard to be. Free income from swap activities. Also, every time someone make a trade, you have a fee, like you have an exchange at the airport. Pairs of coins, everybody needs to exchange, they pay you a fee, right? That's great. And you can make that without continuous paying attention, different of a centralized exchange or trading. You don't have to keep putting a price on this. There is a third one kind of, but it's essentially V3. V2 V3, wide liquidity versus concentrated liquidity. There's two kind of liquidity pools. There's a third one. The third one is only a variation of the V3. V2, you put your money there and they will spread your liquidity all over from the entire range of the price. V3, on the other hand, can concentrate your capital. You say, I'm going to provide liquidity from this price to that price. And during that interval, you're providing liquidity for the market. If the market goes up, you'll be on that pair. Imagine I have a liquidity LP with WBTC and USDT. If the Bitcoin explode, I will sell all my assets on that pool. I will be exposed only on USDT. If the BTC falls, I'm going to buy everything that my dollars are going to buy until that price point I set as my range. The V4 only, it's from last year, but no one actually are putting money there. There's a few, no much liquidity on V4 because they introduced hooks. You can programmatically change your range and everything, but no one seems to be caring about this. So this is the distribution of capital. You see this graphic here, this blue line is your liquidity. You put $100,000 here in a V2 pool, they will spread your liquidity through all the price range. In a V3, you can concentrate your liquidity. You see, your liquidity is going up. Why this is important? Because the greater your liquidity here, the greatest is your fees reward. You know, if you can narrow your liquidity, you are participating on the market maker as a bigger player. So you earn more fees. So the V3, everybody uses V3 nowadays because of this. And this opens some interesting opportunities for us. So there is a few hiccups with this. Imagine this is three pools, right? We have WBTC in this price of range. In this range, if the Bitcoin goes up or goes down, I will earn more fees in this range, but the probability of this escape of this range, I'll be exposed only on USDT, or I'll be exposed only on BTC is greater here than here, right? But I will earn more fees on this kind of pool. So the narrow the range, the greater the fees, but so this is just for illustrate the concept of liquidity in a liquidity pool. Impermanent loss is pretty much what I'm talking about. Sometimes the price goes and your narrow range, you pretty much keep on the same coin. You don't want that for that strategy, but the market goes on and goes for, I don't know, $120,000, but your range was in $100,000. You sell every WBTC you have at the price of $100,000. That point forward, you don't earn any kind of fee because you're not providing liquidity for the market. So you have this impermanent loss. The market goes up, you are not earning anything, and your sell price was $100,000. If you, on the other hand, if your WBTC wasn't in a pool, you still have the exposure at a higher price. It's a cost of opportunity. So before you making a liquidity pool, you can see that the lowest risk is stable versus stable pool, stable coin with the stable coin, USDT versus USDT. They never will have a volatility greater, and you always will be in range, but your earnings is pretty much small, right? But it's a constant. Moderate correlated assets. I mean, I will make a pool with Bitcoin and Ethereum. They are pretty much correlated, right? So if Bitcoins go up, Ethereum goes up, you're still in range. If Bitcoin is going down, Ethereum goes down, you can keep on range. But the correlation is it's to be studied. No, don't take Bitcoin and Ethereum as correlated assets because I don't think it's anymore. Higher risks. This is what I like to WBTC with stablecoin. I would like to make this kind of pool. It's a volatile asset and a stable asset. I like pretty much WBTC because it's the only coin I keep track of the price, actually. So highest volatility, volatile with volatile pool. There's people who take a recently created pool like Melania coin, Trump coin, and make pools of this kind of assets. Mostly they lose money, but it's a bet, it's a gamble. You can make pools of any pair. There's a token in a blockchain, you can make it a pool. I don't recommend. Founder-friendly LP designs. So for founders, that I think it's important. Stable with stable, blue chip stable. Blue chip, I think WBTC, CBBTC. Tokens pegged to Bitcoin value with stable. Ethereum with stable coin. So you name it. It's a good potential for yield and directional volatility. If you know a little bit about market, you must see this. We are in a downtrend. Okay, so my liquidity pool should be in this range. Now we are in a uptrending market. I will change my range to make another strategy. Liquidity pools can be used, as we talking with Mateus, to make your DCA. There is no problem if you have $1,000 and you want to buy Bitcoin at $50,000. You can go to a DEX or Uniswap or whatever DApp you want to use for your pool, and you put your range from, I don't know, $6,000. Now you are at $62,000. Okay. I will put my range from $60,000 to $45,000. I will only put 1,000 USDT in and no BTC. Why? Because I'm expecting to market to go to $45,000. So I will buy Bitcoin on the downtrend, earn fees during this process, and when the market goes to my target, I close my liquidity pool and cash the WBTC. So it's a strategy to make your DCA and earn money. And the other way is possible. You can make your exit DCA. I would like to sell my Bitcoin at $100,000 to $150,000. Here's my WBTC or my CBBTC, whatever. When the markets go there, they will keep in that range for a while. They extrapolate your range, close your pool, cash your assets, and you sell your Bitcoin for the price target you are expecting to do. I use liquidity pools most for that, for going DCA for buy, and DCA for exit. So I will pass this. It's pretty much boring, but we're talking about now what kind of assets I'm effectively long or short, how much real volume those the pool process, where those API come from, fee or incentives. There's some dApps who give you incentives in their tokens. We're talking about earlier. They are make your liquidity pool here, put your money here. I will give you the fees, more this from more plus this yield in my tokens. But these incentive tokens, for me, they are not attractive. So, structured lending. This is the second strategy we're going to talk about. Lenders earn interest from borrowers. Like a liquidity pool, there's dApps for lending in DeFi. You're going to put your asset as a collateral, right? You're going to lend your assets. You're going to make your assets available on their pool. They will earn that fees. You're going to left your asset there. Think about, I'm going to put WBTC here at $10,000 here. They will use this $10,000 to lend this WBTC for others at a yield. They will charge an APY, and they will give you another APY. In WBTC, usually less than 1%, and they will take, I think it's 3 to 5% of a lending in WBTC. But if you have this WBTC and don't want to sell it, you can use your money lending this WBTC for them. Put your WBTC, your asset, as a collateral in this dApp, and take a loan in a stable coin. Use this stable coin for whatever you want. I'll tell you from my experience. I need to buy another 3D machine, 3D printer, and I don't have money at that time, but I have my assets. That's okay. I will put my WBTC in a dApp protocol. I will put a huge amount more. We are going to talk about TVL later. I will take a loan in the amount that I need. I asked the guys for, okay, if I pay this for this that 3D printer in credit card, how much? And it's not. I'm not gonna finance this. I'm gonna pay upfront. How much it will cost? $1,000. Okay. And if I pay in PIX now, how much? 50% less. Okay, I'll take the PIX. I take my dollar. I use it another dApp. I pay the guy in PIX, and I have 50% discount on the same machine, right? It's great. But I have a land on the same $1,000. But it will cost me 4% a year. So take my money. Okay, I will pay you in PIX.
So you're using the Bitcoin as collateral.
Yeah.
You're taking the loan in stable coin.
Mm-hmm.
You're off ramping into dollars.
Mm-hmm.
You're
Mhm.
You use 15% as a hedge.
Discount.
basically, to offset
Yes,
the
this.
cost of 3 years at 4%
Yeah.
is 12, so you still save 3%.
Yeah, not only that, because I still have my WBTC.
Yes, you still have it.
If the Bitcoin goes up,
Yeah,
I have a loan in dollar.
yeah, totally paid for.
Yeah. So I use this strategy to travel, to change my car, to buy stuff for my business. You know, this guy here, this is a product of mine. The Chinese asked me to make some, I guess was 30 or 40. It will cost that amount. Okay, can I pay in USDT? Yes, you can. Okay, take a loan, pay them. Those guys are already paid because the Bitcoin was, I don't know, recall $30,000 or something like this. So I just pay my loan with the volatility of the Bitcoin. But if the Bitcoin drops down, just like my car, the biggest loan, when I took that loan, the price of Bitcoin was about $100,000. So now it's $60,000. So what should I do to not be liquidated? Because, I have a loan, I have to pay. But I don't have to pay every day or every month. I don't have to pay ever if I don't want to. Just it's adding up yield. So what I did, my DCA goes into that collateral. I start to buy more Bitcoin. But the price dropped. What the Bitcoin I do? Buy Bitcoin. So I keep buying Bitcoin. I'm not paying the loan, just adding up my collateral. When the tide change, when hopefully next year, it will pay for itself. And maybe I pay for the loan or don't know what I'm going to do. So that's the thing we can do with loans in DeFi. So, but we should be attentive from the three numbers here. LTV, loan to value, how much you borrow versus collateral. C, LTV is how percent of your collateral you can take as a loan. I saw people taking 50%, 60%, 7%, and starting to get liquidated in Trump tweet. It's a volatile market. You can have a cushion. You need to have a buffer of liquidity in your collateral. So I have some strategies. I have as collateral some stable coins. So the buffer of the volatility. I have this strategy now is going down. I just keep doing my DCA on that collateral, or I close some liquidity pool and put the money as a collateral. So this is loan to value. You must be aware of this number, and it will change accordingly to with your assets value. Health factor, it's your buffer before liquidation. If you access AV and take a loan, they will be giving you a health factor. A good health factor is 1.5, 1.6. At health factor of 1, you start to be liquidated. So you have to understand health factor. And borrow API, it's a floating cost of liquidity. Every time you put your collateral, they are paying you interests, APY, for that collateral. But if you take a loan, they will charge you that APY. Usually, you need to understand the correlation between those two to see if your strategy is doing great or not.
So just
Mhm.
Is that a standardized buffer, or who dictates the health factor?
No, there's no one standard for this, and sometimes the debt make some magical accountability tricks and change your healthy factor for that
Yeah,
specifically pair or collateral.
right.
You can be aware of your position, see what your debt are
So
doing.
you really got to trust these guys then, because depending on that, that's to me is the biggest risk.
Yeah,
Who's setting that risk, that factor?
yeah. So if you, for instance, if you have a collateral in one coin
Yeah,
and you take a loan in another coin and that coin has no liquidity, you'll be less charged. But if there is a huge inflow of that coin, your APY will be skyrocketing. It's a floating number, so
But also add here that health factor also depends on the exchange,
mhm,
on the lending protocol,
yeah,
or exchange on the assets. Sometimes loan provider has to get like 20%, sometimes 80%. So it really might depend on the system.
now I'm gonna pass for talk about looping. Looping is a quite interesting thing people do with low lending protocols. So for structured lending patterns, cash extractions, pretty much what we're talking about. Grab money to use the money to do something. I need cash flow for my company. I need to buy some equipment. I need to upgrade something with an emergency. I'm not going to sell my assets. I just take a loan. Yield spread, you supply assets, borrow asset B, then spread is positive. Imagine that it's pretty much carry trading, you know. You put your asset there, take a loan, and do something else with that money. Let's say I have an opportunity, they are paying 15% yield on this kind of asset. I can borrow that asset. Okay, take my Bitcoin, give some, I will put there. Are you paying me, uh, charging me 6%? Okay, they are offering me 12%. Okay, I have a positive yield of 6%. You can do that. Risky, but you can do. Looping is interesting aspect. You take your Bitcoin, one Bitcoin, you put your one Bitcoin there, and you borrow 60%, 70% closer to the maximum of the allowed loan you can take. And what you do with that money, you buy the same token. You buy more Bitcoin and you put as a collateral. When you put the same token as a collateral, your margin, you take another loan and you put there. You take another loan and you put there. And you're going to do this looping. There's people just doing this every time. Now it's a good time to be aware of this looping strategy because when the markets go to change for a bull run again, I will start to testing looping. I will do. Seems to be a very good strategy to make more money.
Too good to be true.
Yeah, but
But if it's there, it's a loophole, right?
yeah,
You gotta use it. Somebody will close it eventually.
no, they don't.
No?
No, but
They always make money with the fees.
Yeah.
Yeah.
Oh, yes, on the fees.
the fees,
Fees. Okay. Yeah.
you know,
Interesting.
I'll try to do this.
You can be a bit more clever and try to land second time with the asset that's not correlated with the first. Yeah, I mean, even though crypto, like the majority is related to Bitcoin, maybe you can try to find that.
So what, for example, why wouldn't I buy gold? Yeah.
I was talking to a friend, and he does an interesting strategy. He buys a lot of, for example, an ICO, like a coin, a token, and he buys a lot of it before the launch.
Mm-hmm.
And then he goes to the poly market and he bets against.
Yeah. It's the hedging. Yeah.
He does it in an interesting way that no matter what happens, the bottom line is good.
Yeah. So, another strategy for shorting something, every time you take a loan, put in Bitcoin or another crypto asset, you are shorting the dollar, right? Essentially, you are shorting dollar. But what if you is in the bear market, put your Bitcoin there, loan in another kind of coin? You know that kind of coin will drop much more than Bitcoin. Let's say Bitcoin is $1,000, 100,000, and you take Ethereum, or I don't know. No, Ethereum is not the good example, but take a loan in another token. You know that token doesn't have the foundations to sustain a bear market, right? That token will drop much more than Bitcoin. There's a point on you pretty much don't have to pay anything. You can buy that same token, repay your loan, and it's a good strategy for a bear market. I don't have the courage to do that.
I would also add here that if this shitcoin skyrockets,
Yeah.
then we just don't give them it back and just have this shitcoin.
Yeah.
And then sell it.
Yeah. No, but the idea is to take that loan, swap to dollar or something, do whatever you want to do with the dollar, but your contract, your loan is on that shitcoin. No? But whatever, it's.
So sorry, I didn't clarify that further. So if I buy the other coin, that's an asset. So if that coin is depreciating, even though I have a loan, they're gonna come collect that coin, right?
Yeah, you must repay in that coin. Every time I need to close this, I need to repay on that coin. That coin you took is the same coin you have to pay.
Okay.
So.
But I mean, the strategy can be even like more interesting. Just take some shitcoin. If it goes down, then no problem, we give it back.
Yeah.
If it goes up, you just don't give it back, and you're rich.
Yeah. Yeah, it's a good strategy.
Well, and then let them collect the Bitcoin as the collateral, right?
Yeah, but whatever.
But swap it to Bitcoin and
yeah.
He swap it back then.
But you are rich. You can do whatever with that value. Founder use case. I don't know about the time. It's 9 o'clock. So founder. So founder use case, you put your liquidity without selling. Hold collateral, borrow stablecoin, fund runaway need, repay from cash inflow, release collateral. That's the flux. Yeah? We are pretty much what we are talking about. Yeah, that's pretty much what we are talking about. Yield spread in lends. So borrowing just makes sense in those cases. Must be positive after borrow API, protocol fees, gas bridge costs, slippage, and tax impact. That's everything you need to calculate before this. This is a good strategy. You should be aware of those guys. And must survive change in rates, incentive emissions, collateral price, liquidity exits. Again, pretty much what we're talking about, right? Those strategies. So just key points to keep in mind. Liquidation is not a warning, it's an event. You see, if your markets go against you, you're not going to have time, so be aware. The rule of thumb is designed for the bad days, not dashboard APY. Just people look at the dashboard APY and how gonna take this loan, are gonna make this liquidity pool, and don't understand all that concepts we are talking about, the volatility, the kind of assets you are talking about. So I see a lot of guys, oh, I get liquidated, I get, because you just the APY. It's just, if there is a thing too good to be true, not true. No, don't be tempted. So price drops reduce collateral value, borrow API can increase carrying costs, Oracle or liquidity shocks. There's a high risks about Oracle. So new dApps, I don't touch those guys. I just keep the blue chips one because I saw so much trouble in Oracle or liquidity shocks. So I don't touch that guy. New dApps. There's how many years? 2 years? Okay, I'm gonna see and check this dApp. And again, never borrow at maximum capacity. Remember that? Leave a buffer. Take at most 50% of your collateral in loan. Never more than 50%. I like to be comfortable at 30%. I know I will have time to provide more liquidity or change my strategy if the markets go against me. So this is a principal thing. And there is this combining lending and LPs. You put a collateral, borrow a stablecoin, make a liquidity pool, earn fees from the pool, repay and rebalance. This is a risk strategy. I did it, it worked, but I changed the strategy because this is time consuming. You need to make the liquidity pool narrow and keep an eye on it and see if it's providing the fees you think it will be providing. The fees could stop flowing if you go off range, or if the market just going lateral for a while, so you're not going to repay if this is your strategy. Yeah. So if this is your strategy, no, I will take a loan and make a liquidity. I will take a loan and we'll make with this loan a liquidity pool to earn fees and to repay the loan. So, it's time consuming to be. Risk control for founders, segregated wallets by function. This is more rule of thumbs. You must understand this. Segregated wallets, vault, operations. Here, you're working, experiment. This is your gonna test strategies. This is your consolidated strategies. This is the thing you don't touch. This is your treasure. Use the hard wallet and multi-sig for treasure-sized funds. So if you have a treasure in crypto, you must use hardware wallet. I say you should use a hardware wallet for everything, except for small payments things, you small amounts you have on your cell phone. And multi-signature, it's another good strategy if you are talking about a large amount of money, if you have a business partner, and this kind of strategy you must consider. So everything is predefined position limits, LTV caps, and Q switch. Make your strategy. So security, most of the times people lose money on DeFi is for operational reasons. They don't pay attention what they're doing. They send money to a scam. They click on a DM or a email they have on a Gmail. Pretty much a scam will try to fish you every time, mostly in DeFi. Review token approvals, revoke and use that contract permissions. So I propose here for anyone who wants to try a 30 days implementation path. Week 1, understand policy wallets, custody reporting, be comfortable with that in 1 week. Week 2, dry run, scanner, deposit withdrawals, try to understand how to use those tools. Week 3, a small liquidity pool or a lending pilot. Week 4, review your profit and loss, risks, expand or stop. Decision matrix for founders, but I take this here. If you intend to have idle stablecoin yield, the low risk start point at blue chip lending supply, avoid leverage looping, that looping I told you. If you have going for a fee revenue, stable and stable on liquidity pool, on liquid decentralized exchange, blue chips every time. Avoid thin volatile pool. In those dashboards, you can see the liquidity pool, the amount of money they have. Sometimes they are the 2 pairs of good stable coins, but they have $1,000 in liquidity. Don't put your money there. You'll be the liquidity exit for someone else. Cash access. If you want a cash access, imagine you need to buy a tool for your job or for your company. Conservative collateralized borrowing, is that what I do. Never maxed LTV, what we told you, lever cushion. Learning, if you try to learn more about this, small experimental wallet, but I don't know how small is for you, but you can start a liquidity pool with $1. Will not be profitable, but for the mechanics of the thing, you can do this, just to learn, to understand how to sign a contract, how to put your money there, take your loan, see how the percentage, your yield will be 50%, 10% of $1, but will be 50%, You see the numbers and you test your strategy with a small amount. Well, illustrative case, it's what I'm talking, assumption, $1,000 in stablecoin treasury sandbox, take 7% on blue chip lending supply, 20% stable to stable liquidity pool, 10% taking on account, 10% will be spending in gas, testing, emergency buffer. You should reserve 10% for those kind of thing. And I put some checklists before deploying capital for founders. Do you understand where yields come from on this strategy? It's a question you should answer as yes. Can you exit without relying on single bridge or a team pool? Are your wallet permission and custody control defined? Do we know our liquidation thresholds and alerts? Can finance reconcile a position monthly? This is if you are taking this to your accountant and now I implementing this on my company. I need to know if my financing department can understand and how to process these gains and losses and everything. So before you try to do this, ask for your accountant if it understand how to declare, how to see how the taxes going in your strategies for your company. Is this position is more enough to be a lesson, not a crisis? So never jump straight in the pool. Just tip your toe, see the temperature, and only if you are confident, just jump in the water.
Look at the sharks.
Yeah, look for the sharks.
The sharks in the pool.
Yeah, and we have sharks in this pool, definitely. So, any questions again? I know it's my pace, it's not to go, Alex.
Don't think that if you exclude lending, the file is basically there.
Yeah, liquidity pool.
Liquidity pools are there.
Yeah.
There is nothing, no liquidity there like for the past 5 years.
Yeah, but
so like if if you exclude RVA, which is not DeFi. If you exclude lending, there is nothing there, and it's so risky.
Yeah, it'll be just swaps
so
and yeah, it's swaps,
but like it's so
But
risky
you see,
compared to sex, so
yeah,
it's for very limited number of people.
yeah, I don't know how to answer that, but what I just see people starting to use it, DeFi more and more, and TVL growing even in this bear market.
But TVL is not growing.
No, because there's more liquidity. There's more every time in a pool. Imagine a pool with a huge TVL. Your amount is small,
But I
Yeah,
think
you're earning.
it's not growing.
No, not growing right now, and especially in this bear market. I was expecting it shrink a little bit more, but I see it kind of keeping the activity. I was expecting more dapsing. I was expecting more blood in the market, but I'm not seeing.
Trump isn't finished yet.
Yeah,
He's doing wild card.
yeah. The exciting part is just a tweet. Just tweet something. Do something, man.
because like seems like outside over collateralized lending,
Yeah.
which could like exist without blockchain. Yeah, it could be done even on gas rails.
Yeah.
There is nothing there in the DeFi world. Although I'm like love this world, but
Mhm.
there is nothing there left. It's almost dead.
Yeah. So, man, I
See something big.
yeah. Happy birthday. Muitas felicidades, muitos anos de vida.
Thank you.
Make a wish.
My way, oh my God, so many. Thank you. Oh. There we go. Thank you so much, guys. I'm really honored that you've done this. I'm big on parties, but I'm 50 today. Wow! It's a big one, apparently.
Nice, man.
So thank you very much, and a big thank you to Paloma as well, because I've been very busy on a patent that I'm totally distracted, and she's like, "Are you coming on Thursday?" I'll get good cake. But you're a really good person. Thank you. Because that was the reason that I came across.
You deserve it.
Very kind. of you.
We're happy to celebrate you.
Well, thank you. We're doing it. We're doing it. Thanks very much, guys.
Plus, the cake is sugar-free.
All right, guys. Took me in. All right?
So no guilt trip.
I think I'll let the chef
Right?
sort this one out for me. Yeah.
No guilt.
You give everybody else.
Yeah, let's help.
Thanks, guys.
Awesome.
Oh, and I.
So let's put some music and the Q&A continues.
Yeah,
The Q&A
Very
is
nice
over
lecture.
shortly.
yeah, but
And beer.
in English I can't keep the pace, It's just
Yes,
make
it's
this
good.
interesting.
I see that, but you're like that. It's
Mhm.
good. Yeah. Not sure that like the people don't fully understand
Yeah.
what we're talking about, but I understand
Yeah.
that like there is much to discuss.
Yeah. The idea is just to expose everybody with this concept. We don't see everybody using DeFi here. People think crypto is just, I have Ethereum to pay for something. I
Yeah.
will hold this forever.
But like at the beginning, I went deeply into DeFi. Yeah.
Mhm.